Good morning, everyone. So there's been quite a bit of movement and discussion around life insurance commission reform over the last 18 months. Things appeared to be settling down just in time for this presentation, but then we didn't foresee an election being called just prior to the legislation actually being passed. So we are somewhat in limbo at the moment in terms of where the reforms are at, please keep that in mind as we go through, because there are a number of references to a 1st of July 2016 start date. Things aren't set in stone just yet, and in particular the timing looks like being later than expected. So firstly, I just want to acknowledge that this is a very broad and deep topic. There's a lot of areas that we could go into, but we're not attempting to cover everything today. So we'll run things in three parts. Firstly, a brief overview of the changes, expected impacts, then going into more detail around assumption setting for lapse rates. We won't be going into detail around sales, expenses, pricing, capital requirements and so forth, but happy to take questions around those topics towards the end. And then finally, we'll be rounding out with a bit of crystal ball gazing regarding the future regulatory environment. So the key elements of the life insurance framework, or LIF as many people like to abbreviate it as, are up on the screen. The key elements include the remuneration model, in particular caps on upfront or caps on first year commissions, as well as extended clawback periods. An industry code of conduct, and the FSC has already given the industry a bit of a preview on this at the FSC conference in March. And a third key element there is an FSC standard on approved product lists, and that's one that we'll come back to in a moment. So, as I said at the start, the LIF legislation itself won't be passed before the 2nd of July election. So there is a bit of a holding pattern in terms of implementation, but the reforms themselves broadly have bipartisan support within the Parliament, so it is likely that they'll pass in some form shortly after, but nothing's ever certain. So there are a range of impacts expected. From the advisor's point of view, there's obviously a significant initial cash flow impact and a need to think about whether current business model remains viable or whether they need to change and think about how they service their customers differently, and how they charge for their services and how they bring greater efficiency into the process. For insurers, there's an obvious need to have reviewed pricing and to support advisors through this change. And that is partially in terms of understanding the impacts on their business, but also helping with the improvements around productivity so that the remuneration model can work for all parties. For customers, we've got the question mark there because it's all a little bit less clear-cut. So most insurers, we find, aren't really finding the scope to reduce premiums as a result of the changes in the remuneration models. Basically, the additional trail commission offsets any benefit from lowering the first year commissions. But this is a little bit different from insurer to insurer. But broadly, any pricing benefit is dependent on future retention benefits or reductions in lapse rates and future efficiency being brought to the process. So lastly, just listing out a few of the risks and unknowns in terms of where we're at. As I mentioned, there is part of the LIF package is the push to have a industry standard around approved product lists with a view to widening them. So two quite clear impacts from that are The value of institutionally owned distribution will reduce, as the APLs are currently quite narrow. But this kind of change would obviously favour those who are already competing strongly in the IFA market. In terms of grandfathering, really just raising the question there, is there potential to use these grandfathering provisions to help advisors subsidise the drop-off in initial commission? So there is an element to the, draft regulation allowing certain arrangements that are pre-existing to be grandfathered. So there is that possibility. There's plenty of smart people in the room to think about how that could be used. But the obvious downside to all of that is, it's potentially undermining the objectives of the LIF framework. The third point there is very important as well, and it's one we'll come back to a bit later in the presentation. So the government has tasked ASIC to review the effectiveness of these reforms in 2018. Now, the potential is there for further reform to happen and take the form of level commissions being mandated should that review not show significant progress in improving customer outcomes. So I'll leave it there for now and come back to you a little bit later. So for now, Tyson will move into some discussion around lapse rate assumptions.
Thanks for that, Kim and Dale, and good morning to everyone in the room. As Dale mentioned, I'll be talking about the actuarial implications. Now, the angle that we're taking on this is what are the actuarial implications for insurers, specifically through the impact on lapse experience, lapse analysis and lapse assumption setting. To start with, we'll discuss a bit of an industry view. So Dale and I held discussions with a number of actuaries across the industry to get an idea about some of the expectation and proposed actions in light of the commission reforms. The first topic that we discussed was what is the expected change over the coming year, so the next 12 months. And we largely grouped them into three sort of buckets. So will there be an increase in experience, will it be relatively stable, or will there be a reduction? Now, going into it, we thought that maybe it would be skewed towards more the reduction side. But what was evident is that there was actually quite a lot of variability amongst the industry in where experience might go. And we asked ourselves, why is it that actuaries are expecting minimal change? Why is there this uncertainty? And we hypothesised a number of potential reasons, first of which may well be because in the back of everyone's minds, people knew that it would get to 1 July and it wouldn't actually be implemented. Number two, perhaps some of the expected improvements in lapse experience have already come through. So in the industry data we see over the last maybe 12 to 18 months, the average lapse rates have been coming down. And this is perhaps a reflection on greater regulatory scrutiny on advisor conduct, and that part of the anticipated improvement has already occurred. The third potential option is that the existing upfront business, at least in the short term, might be traded for the new LIF higher renewal commissions and increasing lapse rates in the short term. This is particularly relevant over the transition period, where the renewal commission will jump up and the initial commission slowly reduces. The next topic we discussed was, in light of these expected changes, are actuaries proposing to make any adjustments to assumptions, of course from the effective date? In this case, we were, surprised to see very few proposing to make detailed adjustments at this point, and there was much more centralised around either making no adjustments or making high-level adjustments, particularly on the valuation side. Some were making more detailed adjustments to pricing. I guess this is the sort of ingrained philosophy to setting assumptions where Assumptions aren't really changed until they're reflected in historical experience of X number of years. And in this case, it may result in a bit of a lagged effect if experience does work out to be different. So next, I'm just going to discuss a number of potential lapse rate outcomes. Now, we certainly don't have a crystal ball, and these are just a couple of simple scenarios that might happen because it's useful to think about a couple of the drivers in particular. Now, even if lapse experience doesn't change in total magnitude, we do expect that it will change in the shape, particularly when expressed by a number of lapse drivers. So what we have on the screen there is what we would call a sort of a typical shape when expressed by duration. So obviously the initial spike in lapse rates, tailing off to something a bit more consistent, a bit lower as the policy duration increases. So it's useful to think about the drivers of this and what's driven by sort of the advisor impact and what's driven by the customer impact. So the advisor impact really, I mean, I guess it's the churn which is driving that initial spike in lapses. The customer impact can be thought of, I guess, in two aspects. First would be customers not satisfied with the product, and that links back to advisor as well. And also the customer no longer needing the product. So that's more the pure customer impact. So the first scenario that we'll show is a fairly simple scenario where some of that advisor impact is addressed. So lapses are reduced during the clawback period. And then shortly after the clawback period, they trend to something consistent with what we're seeing now. The next scenario might look something like this, which is more of an optimistic outcome. So in this outcome, similar to the scenario one, part of the advisor impact is addressed, but also part of the customer impact is addressed. So we're seeing advisors, the churn's reducing, but we're also seeing customers who are more satisfied with their product and they're hanging on to it for longer. So this is obviously a better outcome for insurers and customers. Now, if we're going to show three scenarios, we have to show a more pessimistic outcome. Now, we can't ignore the fact that the proposed structure still has an initial commission that's 3 times higher than the renewal commission. So there is still some incentive for advisors to move their business around seeking that initial commission. So that could look like many different shapes. It could be simply the spikes move to the right, or it could be that shortly after the clawback period, experience just increases. And that's what we're seeing here. So in terms of the profitability outcomes, this scenario 3 is certainly a suboptimal outcome for all parties. Obviously, poorer lapses bad for insurers. What's bad for insurers is generally bad for the customer through higher premiums. And the advisor impact is interesting. Given the new the renewal commission that's increased, there really is a benefit to those advisors with a long-term view for those that hang on to their policies, because when you discount it all back, the present value of the commission stream under the new structure is often higher than the existing arrangement. So in this case, the high lapses will actually act as a detriment to advisors as well. Now we'll just touch quickly on some other drivers of lapse experience. The previous slide considered how the shape of experience might change when expressed by duration, but insurers use a wide variety of other factors, some of which are on the slide there. And the factors that are likely to change are those that are impacted by or those that drive the incentive to churn. So those are essentially factors that impact the size of the commission or the ability of the policy holder to be re-underwritten. So, aside from the obvious ones like duration and commission structure, age will likely be an interesting one. So obviously premiums increase with age, but also the older you get, the higher the underwriting burden. So there could be some interesting shape changes going on there. And sum insured is the other one, which, similar to age, is driven by both, but it's more likely to impact the size of the premium and the size of the commission. One thing to note is that a number of insurers are currently using multiplicative loadings, and it's likely that if the shape does change for one or more of these factors, those loadings will likely need rebasing. In terms of actually analysing experience, we all know that there are a number of issues in analysing experience. Those aren't going to go away, and it's likely that we'll be faced with a number of additional challenges. Some are obvious. For example, you're going to need to be able to identify commission structure in the data. Hopefully everyone can do that now, but it goes maybe one step further than that. Insurers are likely writing some sort of hybrid product at the moment, and ideally we'll be able to identify a commission structure pre and post lift in order to properly examine experience. Judgment versus a data-driven approach. I guess this presents a bit more of an opportunity to use more judgment in setting assumptions. So we're going into a world where there's likely very little data on experience with commission rates like this. And it's likely that insurers have gone through some exercise on the pricing side to develop assumptions for pricing purposes. And this presents an opportunity to use some of that judgment on the valuation side as well. Now, the length of the investigation period and the multi-dimensional and multi-period analysis are two tools that are likely to help identify whether there is any sort of structural change in the lapse experience. And in terms of the last one, I'll just run through a quick example of a simple piece of analysis that might help insurers to identify whether experience pre and post lift is significantly different. So just to walk you through it, this is somewhat similar to a typical setup for a lapse investigation performed in 2016. Say it's 4 years of experience. So this is effectively saying we've got an average experience during 2016. At the moment, we're lucky enough to have a simple pre-lift world, admittedly not as simple as everything being on 110.10, but let's pretend it is for now. Moving along, the water's going to start to get a little bit more muddy. So in 2017, we've got potentially 1 year's worth of lift experience coming through. And then rolling that forward, by the time we get to 2019, we've got a mixed bag of different things. And exposure for a post-lift world is going to start to increase and have an actual impact on the results. Now, of course, the other key method that insurers use to analyse experience is by policy duration. So you can see particulate policy duration 1, by the time we get to 2019, we're looking at 4 different commission structures, each potentially with different lapse experience. So it gets a little bit more complicated, and this effect will take a number of years before it works its way out of the experience investigation. Now, what's potentially a good idea to help identify whether there is that structural change is simply to split it into something like a pre-lift, post-lift. And then potentially there's room to further delve into that and see whether during the transition period itself the experience differs by commission structure. Of course, recognising that the deeper you go, the less data there's going to be to actually analyse, but it could be used to identify indicative trends and indicative differences. And effectively, this sort of analysis can help insurers to appreciate whether there has been a difference, and then using some of the judgment, insurers can I guess limit the lag of reflecting potential future experience in assumptions. So just to wrap up on the actuarial implications, we've made a number of observations and a couple of expectations. So firstly, there's uncertainty about the impact. Some benefit is expected to have already occurred, and whether there's further impact is uncertainty. There's a bit of a wait-and-see attitude amongst the industry, and there are expecting to be, along with those that already exist, some additional challenges in analysing the experience. A number of opportunities are presented. Firstly, insurers can revisit and restructure experience studies in advance. Consider using more judgment or judgment from pricing in setting assumptions. Consider future regulatory changes. This might not be it, and Dale's going to touch on that in a minute. And effectively, all these opportunities roll up into avoiding to lag the experience. Thank you for that, and Dale will finish off with where to next.
Thanks, Tyson. So, in terms of future directions, just wanted to start off by putting up a couple of international examples. Firstly, with South Africa there, who currently have caps on commission rates. In terms of the regulatory stance there, in 2014 there was proposals by the regulator to change those commission caps further and to take one step even further and prohibit commission on replacement policies. So basically make those fee for advice basis only. Now, they are just proposals, and the latest status update around those is that there's further work and refinement and discussion being had. But it just does give a bit of a sense of what else is happening, and that Australia is not the only country in which the regulator is looking to take measures to reduce the incentive to churn business. So, as we touched on earlier, could a change of government send us in a different direction? Well, possibly, but broadly there's support from both major parties around LIF. I'd be surprised if there was major changes to those proposals before they are put into legislation. But depending on which government takes us through the next 3 years, there may be moves to strengthen those further under a Labor government potentially. In any case, I think all insurers are pretty much ready, set, go in terms of implementing the changes in systems as and when they are required to. So the one I wanted to spend a little bit more time talking about is the ASIC review in 2018. So ASIC intend to gather data from insurers over the next couple of years to inform their review, and they've already stated that they'll look at lapse rates, clawbacks, distribution profiles and the like. And they've also stated their intention to work with industry regarding the collection of that data in order to make it as informative as possible, but also as practical an exercise as possible. I do want to talk about the challenges that process will pose. As I mentioned earlier, the statement from government at the moment is that if there's not significant improvement in customer outcomes, then they'll look back towards the recommendation in the Financial Systems Inquiry around level commissions. So there's a very clear need as an industry in order to avoid that outcome, to do its best to show significant improvement over this period. As I say, that poses significant challenges because what does success look like? Is it about less churn? Is it about less non-compliant advice? Is it about lower premiums for customers? As we said earlier, that's not necessarily an outcome that's looking likely at the moment. Another clear challenge is that we don't really have a fixed definition of what churn is. It's been debated for years. So how are we going to measure it? How are we going to show that there's been improvement? That's clearly a challenge. In terms of available data, among insurers' systems. What can be measured may not necessarily be relevant to the question, and vice versa. So we saw with ASIC's treatment of their initial exercise in 2014, they leapt to some fairly bold conclusions around advisor behaviour and the best way to address it from what was a fairly small sample of data that they collected at the time, and they drew a strong link between advisor behaviour and commission structures. So to some extent I do worry about how the available data and the available analysis might be interpreted in 2016. And then lastly, a clear challenge is the time frame. So even if LIF was implemented from 1 July 2016, which we're saying is looking like it's delayed, so many policies are still in the clawback period by the time the review is needing to be done. So the transition to the final state is not complete. We're not seeing the fullness of the effect of those reforms come through. So, it does raise the question of whether further regulation or further movement away from a upfront style of commission will be inevitable or not. And if it does happen, it has quite stronger impacts on advisors and insurers. So we'll leave it there and open it up to questions. Thanks.